G'day everyone, welcome to this weekend chart update for global markets. And the heading that I've got here is really important this week. I've really modified my view on the Australian market because of events of the last couple of weeks, and in particular, a lot of information that I've found out in the week just gone. So this is a really important video update, I believe. So please take note of what's contained within it. So let's start with the US market, and I have to say that there is a significant difference between what is happening in the US market and what is happening in the Australian market. So you need to be very clear about what I'm referring to. So in terms of the US market, the S&P ended up down 30 points on the week, which is the first fall of that magnitude for some time. And we're seeing quite a divergence setting up now between price and momentum indicators. We've got price continuing to rise, but momentum indicators are now starting to form lower highs and lower lows, which is indicating that whilst the prices are still rising, they're rising at a slowing rate. And that's the first indicator that the market is reaching a short-term top. Now, I believe that something of the order of 100-point retracement. It's really a bit of a gut feel call. I still see terrific strength in the US market in the medium to longer term, probably for the next couple of years. So I'm only talking here about a short-term retracement, which is really necessary because the market just can't keep rising as it is. So looking for that retracement in the near term, whether it happens before Christmas or after Christmas, obviously no one knows that, but the risk-reward ratio of staying in the market at the moment is not particularly attractive. Now, other global markets are rolling over to a greater extent than America. We saw Germany and the UK stock markets turning over during the week as well. So, the signs aren't all that flash. And of course, the Australian market has been underperforming quite a lot. So I remain highly positive on sections of the US market. So I need to make that really clear. I've turned very cautious on Australia, and we'll have a look at why in just a minute. But I do remain very positive on certain sections of the US market, not the whole market. Some of it is overvalued, but there are certainly parts where there is still good value. Now, the ASX 200 index closed down by another 88 points on the week. It was about 134 points last week. So it's, it's been a very, very poor couple of weeks, as we'll see on the chart. And what has changed my view is the speed of the deterioration in the local economy. It's been quite breathtaking. Now, anyone who follows the market knows that mining services companies in particular and resource companies have been under pressure for some time. You would also need to have been living in a cave to not know that Qantas has got all sorts of problems. And we've now got Holden leaving Australia. We've got Ford leaving Australia. So manufacturing is really suffering in this country as well because of the high dollar. But what has really become evident in the last couple of weeks is how quickly that multiplier effect of a pullback in the resource projects. BHP and Rio Tinto have pulled an enormous amount of money out of the project market, and that has a huge multiplier effect all the way down the chain. And we're now seeing poor consumer sentiment, poor business sentiment, really filtering through now to profit downgrades in all sorts of companies. So some of the very best performers of the last 4 or 5 years that have been really very robust, and even as late as August were reporting reasonably robust outlooks. And there's a whole chain of them now starting to downgrade profit in the last couple of weeks. So the deterioration has been extremely rapid, and we just have to take note of it. Now, when you couple that with the poor liquidity, which there's a couple of reasons for that I've spoken about over previous weeks, and the general poor sentiment that's just going through our whole economy, it really is very ordinary, and it's just dragging the whole market down. So you can't fight against it. The fundamentals are deteriorating. The liquidity is poor. Sentiment is poor. You've really got to take note of that. So I'm on high caution alert in the near term for the Australian market. So let's take a look at some charts. First of all, we'll start with the S&P. So you can see, we'll pan back, we can see there's been a massive rally since late 2011. We've had a few pullbacks, a couple of events in 2012, but once we got through that bit of rockiness in 2012, and the ECB basically said they were going to underwrite the European economy and the euro, then there's only just been these periodic retracements of 2 or 3 weeks. We had one in late 2012, we had another one in June of 2013, and then other smaller ones in August and again in October, but really pretty minor. You can see that the red 150-day moving average is still heading up at quite a good clip. The index has not come back to it yet, and you'll notice that the index is poised about as far above that moving average as it ever gets. So that's why I'm really looking for a retracement. It's been quite a while since we had any sort of retracement. You can see that while the price of the index has been forming higher highs over the last 3 months, you can see the RSIs, the peaks are getting lower. The MACD, if you want to use that momentum indicator, the peaks are getting lower. So clearly this market is running out of momentum. It might push up, might have one last little burst and push up to 820 or so, but the potential reward for the risk you're taking is just not worth it. As I read it, I reckon you might have 20 or 30 points of upside and maybe 100 to 150 points of potential downside. Now, I'm not saying that'll happen, but that's a distinct possibility. And that's just a very unattractive time to be doing very much in the market. You can see the momentum indicators haven't by any means unwound yet. So quite a lot could happen to the downside. Now, looking at the Australian index, and as you know, I don't look at this very much because it doesn't reflect accurately what's happening in the Australian economy, but just for the sake of it, we've had a very sharp deterioration over the last few weeks because the banks have been sold down, and it's underperformed the US market, in fact, underperformed just about every market around the world. It's oversold, so we may see a near-term bounce, particularly in the financials, but yeah, it's not looking good on the Aussie market. Turning now to commodities, gold ended up rising by $10 on the week, but didn't really do a great deal. And we're still holding above that double bottom at 1191, and it looks like it could be a possibility. And that level needs to hold. That's an important level. And we're still not seeing anything positive from gold or from gold stocks at this stage. So let's just have a look at gold. You can see there, here's the 1190 lows in June. We're just a little bit above that at the moment, but not really showing any positive momentum. And if we look at the GDX index for gold stocks in America, they've actually formed a lower low. So the gold stocks continuing to underperform gold. And we need to see the gold stocks kick up before we're likely to see gold kick up. Turning now to copper, it actually climbed to $3.29. So a real indication of the strength of the global economy. I mean, the Australian economy is just falling off a cliff, but globally, with the strength in copper, it's looking okay. And that was despite a rise in the US dollar as well. Now, oil steady at 97. I don't particularly like the dynamics around oil. I think we're going to move towards the US economy importing less oil and in future years perhaps exporting oil. We're quite likely going to get Libya and Iran come back to the oil market as well. So I can see the supply and demand equation changing quite a bit for oil. So not real keen there. This is spot copper. Some good strength there over the last week, which is not really showing on that chart, but it kicked up towards $3.30. So just to wrap up, overall from a strategic approach, the Aussie market is vulnerable to more profit downgrades, and we've seen what the market has done in the last few weeks. Any company that falls short of expectation has been getting absolutely slammed, and falls of 25 to 50% are common. And in some cases, with some of the mining services companies, we've seen falls of 80% basically on the open. So you just don't want to be caught up in these stocks because there's nowhere to hide. You're going to get a significant belting on the open on any stock that downgrades to profit. So my strong strategic advice would be to cash up anything that you're not totally comfortable with and only buy quality stocks under the best circumstances that you can find. So that's it for this week's update. I think it's really important to take note of this, and we'll see how the Australian market trades over the next week, but it looks unlikely that we're going to get a rally into Christmas. The US market may do. Let's see what the new year brings. That's it for this week. Cheers.